Welcome to VA Loans versus the Rest. I'm your host, Frederick Middlebrooks, and tonight in this webinar, we are going to be discussing, or rather comparing, VA loans versus other more common loan products that are out there, FHA, conventional, and USDA as well. So without further ado, let's jump on into it. So what sets VA loans apart? I'm going to be going through about 8 criteria that sets VA loans apart from other loan products that are common to see in the mortgage market. So first, with VA loans, we don't have a down payment requirement. There's no down payment required, and this is different from loans that might be offering down payment assistance. For example, right now, particularly with the increased prices in homes and everything, there are a lot of down payment assistance programs out there. However, down payment assistance is different from having no down payment requirement at all, because with down payment assistance, there is still a down payment required. And many times with that down payment, it goes onto the home as a second mortgage. Now, oftentimes there's no interest rate that is attached with that down payment assistance. However, it is something that you still have to end up paying back when you sell the home, refinance, or if you move out and it's no longer your primary residence. However, with down payment assistance, again, there is still a down payment that's required. It's just that that money is coming from another source. It might be state funds for a state funded program, or private funds, or funds from a nonprofit organization or something like that. But there is still a down payment requirement, and often those run through the FHA program. So there's 3.5% that is being paid as a down payment. Also, with those down payment assistance programs, it is important to know that they can come with increased interest rates. That is something that I do see with a lot of down payment assistance programs. Not all of them, but a good number of them do have increased interest rates if you do take that down payment. And so that's something to be aware of as well. But that's not something that you have to worry about with VA loans. VA loans also have very competitive interest rates, and we'll get into that a little bit later, but they have no mortgage insurance as well. And this is a very important piece of the loan process, is to not have to pay mortgage insurance. Mortgage insurance can run you, depending on your credit score, anywhere from $80, $60, or you can be paying a couple $100, $300 or more for mortgage insurance. It varies widely depending upon how much you're putting down on the property and what your credit score is as well. So mortgage insurance can affect how much home you can purchase, how much home you can afford to purchase, and as well as whether or not you even qualify to purchase a home. So again, not having mortgage insurance lowers how much you pay per month for a particular home, because again, your mortgage payment includes your principal, your interest, your taxes, and your insurance. So not having to pay any mortgage insurance will definitely lower that monthly payment. But also having that lower monthly payment means that you can afford a slightly higher purchase price. So maybe you're trying to get a home that's a little bit more on another level than what you currently qualify for. Through a VA loan, not having that mortgage insurance, you may be able to qualify for that mortgage. So that's something that you want to look out for as well, because that is something that you do not have with the VA loan. And as I mentioned earlier, or actually I didn't mention this earlier, but there are no loan limits with a VA loan as well. This is something that is key, particularly for individuals that might have a higher earning potential and they want to get a home that might exceed the conforming loan limits for your particular county where you live in. So in many counties across the US, the conforming loan limit is $726,200. It's a little bit more for more higher cost areas, such as some cities or counties rather out in California, but and a couple of other locations as well. But for a lot of the US, that conforming loan limit is $726,200. So if you want to purchase a home that is beyond that and you want to use your VA loan to do it, if you have full entitlement, you can use your VA loan to purchase that home that goes above those conforming loan limits, and you can finance all of it with zero down payment. And that is a very good thing that you can do with the VA loan. So again, FHA and conventional, they do have loan limits. Also, USDA, which is for properties that are in more rural areas, and they are also loans for lower to middle income borrowers, USDA loans do not have loan limits as well for your single family loan, your single family general loan that you get through USDA. However, USDA does have income limits. And because they have income limits, that in essence will limit how much you are able to purchase on the home side. So there's no loan limits, but since USDA is meant for low to middle income borrowers, that will limit how much you can purchase in a home, because you can only qualify for so much if you're only able to make so much with a USDA loan. So that's something that you definitely want to be aware of when you're making these comparisons and trying to compare apples to apples, if you will, for loan programs, is that with the VA loan, you don't have to worry about loan limits, but you also don't have to worry about income limits, because there's no limit to how much money you can make as well and still use the VA loan. So that is a positive on that end as well. So moving on with what sets the VA loans apart, there's a 1% limit on origination fees. So a lot of lenders will charge the 1%, or they have a set rate at what they charge for origination fees when they're originating your loan, because most lenders, that is how they make money, is on charging origination fees, not on holding your mortgage for 30 years or 7 years or however long you keep that mortgage before you refinance it or sell your home. But there is a 1% limit that the Department of Veterans Affairs puts on VA loans, so that borrowers or veterans are not charged above that when it comes to origination fees. You can have a higher charge than the 1% on other loan products. For example, if you were to get a conventional loan, you might go above that 1% limit. However, with a VA loan, it limits that. So there is no chance of you getting a VA loan and going above that. The lender has to lower their fees to that 1% if they're not already at or below that 1%. So that will save you a little bit of money as a veteran home buyer as well. Competitively low interest rates. This is what I harped on earlier, which is that your interest rates with a VA loan are very competitive on the low side compared to FHA and conventional loans. So you have interest rates with the VA that in many cases, most cases, I would say, are lower than what you will find on conventional loans. FHA is generally better priced out interest rate wise than what you find on conventional as well. And again, that's not set for every single scenario. You could have some individuals with some extremely amazing credit scores. It could also be the lender dependent as well. So there are some factors in there, but generally speaking, VA loans have competitively low interest rates when compared to FHA and conventional, and USDA loans for that matter as well. So moving on, 2 opportunities to increase your home value. So let's say, for example, that you go to get a home and the appraisal comes back low. The appraisal is what determines that the home that you're purchasing is actually worth what the lender is financing for you to be able to purchase that home. So let's say that the appraisal comes back low. You have 2 opportunities as a buyer, which also could aid in the seller, because I'm assuming the seller's still wanting to get this property sold as well, to be able to increase the value of that appraisal. So you have one which is called a tidewater, and that is the first step in you being able to submit comps to a lender who believes the appraisal is going to be coming in low, to try and show the lender, hey, these are some comparable properties in the area that we found that justify the contract price of which we are currently under contract for right now to purchase this home. So Tidewater is the first phase. Assuming that that appraisal still comes in low, you have what's called a reconsideration of value. And that reconsideration of value is the second opportunity that you have to be able to increase the home value for that VA loan and still get everything funded and gone through and everything like that. So with that, it's a little bit additional work in what needs to be presented to the appraiser, and at this point also the VA loan office or the regional VA loan office is going to be roped into the conversation as well to submit this reconsideration of value so that we can try and get that appraised value up a little bit higher as well. But that is something that is unique to VA loans. You don't have that with other loan products. If the appraisal comes in low after you've submitted your comparable properties to try and justify the purchase price, then you just have to deal with the low appraisal. But with the VA loan, you do have that second opportunity to provide a little bit more substantiating documentation to increase that home value as well. So moving on, VA loans being preferred by many lenders. Why is that? Well, for one, the portfolio performance of those VA loans in comparison to the FHA and conventional loans. So what do I mean by portfolio performance? We're talking about the percentage of VA loans that default or that go into foreclosure. People stop paying their mortgages essentially. That is much lower percentage-wise for VA loans than what it is for other loan products out there. And the reason being is because the way veterans are qualified when they are approved for VA loans, there's what's called residual income. Residual income is a calculation that has to be made for everyone that is getting approved for a VA loan. And it is only calculated on VA loans, and it goes above and beyond the traditional calculations of what you see on FHA and conventional loans. For example, with residual income that must be calculated, we look at the mortgage payment, which is your principal, interest, taxes, and insurance. We also look at any debts that you have on your credit report, such as your car notes, student loans, credit cards, personal loans that you might have, as well as if you're paying alimony or child support. But all lenders look at that. So what makes residual income different is that with VA loans, we also calculate how much you are paying in child care expenses. We also look at how much your utilities are going to be, and that's factored based on the square footage of the home. And we take 14 cents and multiply the square footage of the home by 14 cents to determine an estimate of about what your utilities are going to be month to month. And we factor that into the equation as well. We also look at taxes, what you're going to be paying in income and state taxes or state and federal taxes, Social Security taxes. These are things that are factored into residual income to determine whether or not a veteran is actually qualified for this VA loan. And so once we add up all of these debts and all of these other things that we calculate for a VA loan, the residual income is the amount of money that you have left over. And that amount of money has to meet certain marks in order for you to be able to qualify for a mortgage. So that's something that makes veterans very strong applicants and very strong potential home buyers when they are putting forth an offer, is that they have to go through all these additional steps of being able to qualify. Now, you might be thinking, well, doesn't that prevent more veterans from being able to qualify for a home loan? It doesn't. It makes more certain that the veterans that we are putting in homes are able to afford these monthly payments in addition to all of the other responsibilities and obligations that they have. And it also helps give the lenders some assurance as well in knowing that they are in knowing that the loans that they are making, there is a high percentage chance of them being able to qualify. And again, as we mentioned earlier, veterans don't have to pay mortgage insurance. So even though we're making these extra calculations to make sure that they can afford the monthly mortgage payment, it helps out also that the veterans don't have to pay mortgage insurance, which could cost them an extra $100, $150, $200, $300 a month, depending upon credit score and things like that. But since the veteran doesn't have to pay that, that can also help offset all of the other things that we need to calculate. And again, these are calculations that we need to make sure that they have enough money left over at the end of the month to meet the residual income requirements, which is different than mortgage insurance, which you actually have to pay. They don't have to pay any of that residual income money. So again, going that extra step to qualify those veterans to make sure that they are solid applicants and solid candidates for this VA loan, allows them to have a much better portfolio performance, which is something that lenders love to see and makes them preferred by many lenders. And also you've got the VA guarantee, obviously, where the VA is guaranteeing to pay out up to 25% of the loan amount if this veteran defaults on their mortgage and that home has to go into foreclosure. So that's another thing to keep in mind as well. Moving on, we've got more lenient underwriting guidelines. So the VA, believe it or not, does not have a minimum credit score requirement. Now, I caveat that with a asterisk, if you will, because most lenders, just about all the lenders I know, do have minimum credit score requirements. So if they do, whatever they set their minimum credit score requirements at, you still will have to abide by the minimum credit score requirements set by that lender. So if a lender says that, okay, the VA doesn't have minimum credit score requirements, but we require veterans to have a 580 credit score, well, then you're going to have a 580, because lenders are allowed to have what's called overlays. Overlays are requirements, additional requirements that are placed on top of the requirements for whatever the loan product is that you're qualifying an individual through. So in our instance here, VA loans have their own set of requirements, and a lender can place on top of that additional requirements, and those additional requirements are called overlays. Not all lenders place overlays on top of additional requirements, but on top of the VA requirements. However, it is important to know that most lenders do have a minimum credit score requirement. That's still not a bad thing though, because whatever that minimum credit score requirement is, a lot of times with many lenders, you will see that they put VA at whatever that lender's minimum is. So if that lender is willing to go down to 500, then they will do VA loans as low as 500. If that lender says the lowest that we will do for our credit score in any of our products is a 580, then a lot of times you will see that they will approve VA loans down to a 580 credit score. So generally, whatever their lowest is, oftentimes you will see that come into play for their VA loans as well, especially since VA does not have a minimum credit score requirement. So those are some of the things that I wanted to go over with you to just inform you of some of the things that are making VA loans a better option than any other loan product out there if you're a veteran. So if you are a veteran, I highly, highly, highly recommend that you look at getting a VA loan when you are ready to purchase a home. I am a veteran and I purchased my first home utilizing the VA loan as well. It was a good experience. And again, it saved me on the down payment. It saved me because I didn't have to make mortgage insurance payments. So that saved me on my monthly payment. Interest rates were great. I did not have a high interest rate or anything like that. And so it's just all around, it was a good experience utilizing the VA loan. And I also had a good lender and a good real estate agent that guided me through the process as well. So that's all that I wanted to present to you this evening. Hopefully it was beneficial and you gained a lot of good information from it. As always, please follow me on social media. You can find me at GA Loan Officer on TikTok and Instagram. Again, that's GA Loan Officer on TikTok and Instagram. I'm also Frederick Middlebrooks on LinkedIn, but I try to post a lot of good content. Also, if you are on YouTube or if you visit YouTube, hop over to my channel, Greatest Asset Community. That's the name of the channel. It's Greatest Asset Community. I post podcasts on there that I do weekly. I post these webinars. So if you happen to miss any webinars that I've done in the past, you can go to Greatest Asset Community, which is my page on YouTube, and you can get updated with all of those ones that you missed. And I also post shorts on there as well of just little tidbits and tips and tricks that can help you with improving credit score and getting down payment and getting approved for purchasing a home, or just some news or breaking stuff that you might not be aware of. So again, that's what I wanted to present to you. And please subscribe to the channel, because that way you will stay updated on everything that is coming out new when I drop a new video or a new podcast or a new webinar even. So thank you again for taking the time to tune in, and listen to this webinar, and have a blessed day. We'll see you in the next one.